Welcome back, everyone. So we're moving on to the next chapter, which is about current liabilities and contingencies. A number of these items you have heard about in the past through financial accounting. However, there are some new concepts that we need to discuss in here because it is intermediate accounting. So this is probably one of my favorite definitions of what a characteristic of a liability is, because it's got past, present, and future all in the definition. The idea is that you are going to sacrifice future economic benefits, whether they be cash or whatever else, is the sacrifice of future economic benefits that arise from present obligations that you have today to other entities that are a result from a past transaction or event, right? So something happened in the past to have an obligation that you owe somebody something today, and you're going to sacrifice future economic benefits to get there. So, like I said, I think that's a great definition of a liability. So we usually split liabilities into short-term and long-term, right? Current liabilities, long-term liabilities. So current liabilities, those are liabilities that are payable within 1 year or operating cycle, whichever is longer, and they're expected to be satisfied with current assets or by the creation of other current liabilities. Long-term liabilities is pretty much everything else. Some examples of current liabilities. Accounts payable, right? People expect to get paid within a year. Accounts payable arises when you owe money in your regular trade or business. Taxes payable. The government certainly wants their taxes to be paid. Unearned revenues. This is when you're paid in advance of performing a service. So somebody gives you some cash and you have an obligation to provide them a service in the future. So you don't actually owe them money. And that's something I say in financial accounting quite a lot, is a current liability or even a liability doesn't mean you owe someone cash. It means you owe someone something. And with an unearned revenue, you owe them a service typically. Right? So somebody pays you in advance of performing a service, your journal entry would have been a debit to cash and a credit to unearned revenue. And then when you actually earn that revenue, you can start removing that liability with a debit to unearned revenues and a credit to a revenue account. Okay, I'm not going to go into the journal. I'm not going to detail out those journal entries simply because they are a financial accounting concept. Cash dividends payable. As soon as you say dividends are going to be paid, you've created a liability for yourself until you do so. Accrued expenses. These are expenses that maybe you haven't received a bill for yet, but you have you have created the expense, you have incurred the expense, but you just haven't recorded it in your books yet. So a good example of this is your utility bill. You typically don't get your utility bill until the following month. So for example, let's say you have a calendar year-end company and you certainly used utilities in the month of December in order to run your business, but you don't typically get that bill until sometime in January. But because you did incur the expense in December, you need to accrue that expense in your records. And this is usually an adjusting entry. And short-term notes payable are just that, notes payable that are due in less than a year. Some other types of things that we need to talk about are owing the people that work for you. So you could have salaries payable, you could have commissions payable, you could have bonuses payable. These are typically done at year end if you're preparing the financial statements, or they can even be done at month end. They are usually adjusting entries. The idea is that there's nothing wrong with owing people money, salaries, commissions, bonuses, as long as you definitely have the intent to pay it soon. If you think about it logically, let's say that your employees get paid every other Friday, and a lot of people get paid that way. If they get paid every other Friday and December 31st is on a Tuesday and your calendar year-end company, well, then you need to accrue the expenses that you owe money to those people. You owe them salary payments for Monday and Tuesday. Right? Did I say it ended on Tuesday? Sorry, all right, so you're not going to pay the people until Friday, even though December 31st happens to fall on a Tuesday. So in that case, you'd have some sort of accrued salary expense, or an accrued commission expense, or an accrued bonus if you're not going to pay them, right? The idea is that you put them on the balance sheet as liabilities if they're earned, but you haven't paid them. All right, again, typical liabilities. Vacations, sick days, other paid future absences. I don't know what another paid future absence would be beyond a vacation day or sick day. Maybe a personal day. Those don't usually carry over. But anyway, I guess we're leaving it open for any other type of items. But vacation pay. The idea is that the employer or the company needs to accrue an expense for vacations that they have not paid out yet, but that the people that work for you have earned them, as well as sick days. Now, there's a couple of criteria that you have to meet to determine whether or not you should be accruing those expenses. Should be accruing those liabilities and expenses. So you should be accruing those items if the obligation is for a service already performed, so they have earned those vacation days and sick days already. That's already passed. That they can take them in a future year, right? Because some companies have it that if you don't use it by year end, you lose it. It makes their accounting simpler. It makes their liability simpler. And it kind of forces their employees to take vacations. It's kind of funny. You always see companies frame it as, we want our employees to be well rested and take vacations. Well, you know what? There's the side benefit of it making their accounting a little bit easier too. If you don't take your vacation by year end, you lose it. So anyway, in this case, if you can take it in a later year, or you can accumulate it, vacation, sick days, whatever, then you do need to record that as a liability. Payment is probable, all right? Meaning you do intend to make the payment for vacation days, and that you can reasonably estimate the amount. All right, these two items are going to repeat. You're going to see this as a theme as we get into contingent liabilities a little bit later. The payment has to be probable and estimable to record the liability. Sick pay, interestingly, sometimes usually meets these conditions to accrue, but you're not required to accrue them, because the idea is that the payment is probable, and you can't say that future illness is probable, right? I mean, we're not talking about mental health days here. We're talking about actual illness. So, it's a good practice to accrue sick days and sick time if the 4 items up here are met. But it's not mandatory, as it says, because it's not really probable. I don't even know how to say. Some people never get sick, right? I mean, so you shouldn't have to accrue for them, I guess, is the mindset here. All right, interesting kind of concept. All right, so here's some liabilities that we've probably never talked about in financial accounting, and this is liabilities from advance collections. Refundable deposits, advances from customers, gift cards, collections for third parties. Now let's talk about what those are. Unfortunately, I don't have any good number examples for you with refundable deposits, but the idea is that you are to return something to somebody, right? So, you've collected something that I'm trying to think of a good example. Milk bottles. Let's use milk bottles. So, typically when you buy milk bottles, right? This is something that many of us have never had in our lifetime happen. I vaguely remember milk bottles when I was a child, but the idea is that you pay initially, a customer would pay you, the company, for the milk and the milk bottles initially. And the idea is that so you are holding on to money as the company that is for the milk bottles, because maybe the milk costs $5, right, that you're buying, but the company has a $10 deposit on their milk bottles. So the customer actually pays you $15. 5 of which is revenue, 10 of which is a refundable deposit. Now, if that customer just continues buying milk from you and turning over the bottles, that's fine. $5 revenue, no problem. But at the end of the day, if the customer decides, you know what, I'm done with this whole milk service thing, I want my deposit back, I want my $10 back, then the company then has to refund that money. So that extra $10 that company collected in the beginning of that whole milk process would have to be refundable. So the company would have had to record that $10 as a liability on their balance sheet until it was refunded to the customer. Okay, you can kind of almost even think about, I guess, rental properties having this kind of situation. Whenever you put money down, or even a vacation, you put deposit down that you're going to get the money back on, that falls into this category as well. So if you are paying a landlord an extra month's rent as a deposit, or an extra, let's say $500 as a deposit, the landlord's actually obligated to keep that money and hold on to it aside. And if the landlord had financial records, then the landlord would be recording that extra $500 you had to pay as a liability due to the renter until they left the apartment. Okay, so that would be something that would be considered a liability. advances from customers. So this is typically, right, so a customer pays you in advance of you performing the service or providing the product. Gift cards fall into this category as well because I'm getting close to the 10-minute mark. Gift cards, the idea with gift cards is you're paying in advance. Somebody has bought a gift card from a store. The store has a liability for that gift card until that gift card is used up. And collections for third parties, I don't have a good example there. That's basically another kind of catch-all for a scenario. I'm going to start up again in another screencast in just a second.